On the program this week, we're going to give you two things that you need to know to avoid unless you like not making money. Pretty sure most people like making money. So you certainly want to listen in to those two things that we're going to be talking about on the program. Plus, we will cover 5 of the most important financial issues you need to focus on in the new year. Last week on the program was joined by fellow certified financial fiduciary at Nelson Financial Planning, Rob Field. We were going to get to that particular topic, but we ran out of time because there was a lot to unpack as we worked through the show last week, a lot to unpack involving the Corporate Transparency Act. And folks, if you missed that program and you're a small business owner or you know somebody who is, maybe that's in your circle of friends or in your family, you've really got to listen to that program again, because what the Corporate Transparency Act requires you to do is to file with the United States Treasury, courtesy of its FinCEN department, all of the owners of said business. And if you don't do it by the end of the year, penalties can range up to like $500 a day, $10,000 jail time, all that good stuff. So definitely check it out on our various social platforms and podcast platforms if you missed last week's program. Pretty valuable one, particularly for small business owners. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary at Nelson Financial Planning. You're listening, of course, to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest-running radio programs, coming to you here on a broad array of radio stations throughout Central Florida, along with a number of podcast platforms. Make sure you subscribe to us on your favorite podcast channel, along with our YouTube channel as well. Any trouble finding us, go to our website, Nelson Financial Planning. You'll see the icons. They'll immediately connect you through the power and magic of the internet to our stations on those various platforms. So before we get to those topics, there's two things that I want to cover as well here in the opening section. First, a little bit of a recap of January from a market perspective, and some interesting data that we saw this past week that we thought would be good to share with our listening audience. As you know, or maybe you don't know, the S&P 500 for the month of January actually had an up month for calendar month January here in 2024. S&P 500 finished January up 1.6%. So all of that sounds good. Here's the interesting stat we stumbled upon this past week that maybe puts it in perspective, maybe becomes a harbinger for better days as the year progresses through 2024. Here's the stat: in the 40 years since World War II, when the S&P 500 has been up at least 1.5% in January, and as we just said, it was up 1.6% in January of this year, the average performance for the remainder of the year has been an additional gain of over 13%. So that's pretty good. That's kind of the January effect. Maybe you've heard that term before, the January barometer. Sort of as January goes, so goes the rest of the year. Particularly when the S&P 500 is up at least 1.5, and January of this year is up 1.6%. And so based on the data in the 40 years since World War II, median or average performance for the remainder of the year has been a gain of over 13%, with positive cumulative returns over 82% of the time. So interesting little statistic that may or may not put January's strong performance by the S&P 500 into perspective As you know, we do this show every week, so those will be the things that we continue to talk about as the year progresses. If you are a regular listener to the program, then you know that this next thing we're going to talk about is something that we always talk about on this particular Sunday, because this particular Sunday is Super Bowl Sunday. So it would be remiss for us to not talk about the Super Bowl market indicator. We do it every Super Bowl Sunday, kind of one of those fun things that we like to talk about. If you're unfamiliar with the Super Bowl market indicator, it was a concept that was started in the 1970s by a guy by the name of Leonard Koppett, and here's how it supposedly works. If a team from the AFC wins, then that suggests or portends that the market for the year is going to be a bear market, going to be a down year for the market when the AFC team wins. When the NFC team wins, or the little caveat is if it was in the NFL before the NFL-AFL merger, if that team wins, then that foretells a increase in the markets or a bull market. At one point, roughly about 10 years ago, this thing was actually, surprisingly enough, pretty accurate, like 80% accurate, roughly a decade ago. Of course, over the past several years, it's kind of fallen apart. In fact, if you look at the past 8 years, since 2016, it's only been accurate once. So it's been wrong 7 out of 8 times, and now it's only been right 1 out of 8. So maybe we just need to move on and not talk about the Super Bowl indicator anymore, but it's still fun to talk about because that's what everybody's going to be watching and paying attention to as the day progresses. Last year, Chiefs won, so they're an AFC team. If you follow the Super Bowl market indicator, that would have said, okay, well, that's going to be a down market, as a result of an AFC team winning. Obviously, that wasn't the case. Market was up last year. So again, hasn't been correct 7 of the last 8 years. Given the unsuccessfulness, though, we think it's going to hit this year. So we think it's going to be accurate this year. Certainly the odds makers have the 49ers, I think the +2 or something like that. At least that was the last, the last check on that. And so if the 49ers win, then it will be a bull market again based upon the Super Bowl market indicator. So I'm thinking that maybe the 49ers, if they pull it off, then the Super Bowl market indicator once again becomes accurate because it's been inaccurate for so many years. Understand that the whole conversation about the Super Bowl market indicator is just a tongue-in-cheek kind of thing, right? You realize that there's no way to predict the future. It's really just kind of a coincidence, and not a very good coincidence because it's been wrong 7 of the past 8 years. Not sure how it managed to get an 80% success rate up until about a decade ago. But anyway, something fun to talk about when it comes to Super Bowl Sunday. So one of those things that we always like to kind of talk about because, everybody's going to be watching the Super Bowl tonight. I think they expect a record amount of eyes on the program. There will be a football game along with various singing sensations performing at halftime and, of course, in the audience as well. Unless you've been living under a rock, you know exactly who I'm referring to, who will be in the audience. Anyway, or they suspect she's going to be in the audience. Maybe she won't make it back from Japan. We'll see. I think there's a prop bet out there in Vegas on that one, as a matter of fact. Anyway, let's get to the meat of the show. So 2 things that you need to know to avoid unless you like not making money. That's the topic. That's the teaser. We're going to take a break. We come back from the break. We're going to get into the meat of the program coming up after these messages. This is Dollars and Cents with Joel Garris of Nelson Financial Planning. Two things that you need to know unless you don't like making money. First and foremost, and this is something that we've been talking about for probably a year and a half now on this program, and that is this notion of cash rates or interest that you now, after probably 15 years of making zero or next to zero on things like savings accounts, money markets, all of those kinds of things, really the first time in probably 25 years that we've seen those rates, even today, roughly approaching or around that 5%. Well, that's a pretty good rate of return for money that's just sitting in cash. But many still are unfortunately missing out. And this is where it really behooves you to take the time and really make sure to check things out. The banks in particular, the large financial institutions, they have been very reluctant to sort of pass through those higher interest rates to their client accounts. And what's even worse is some of these labels that you hear, particularly ascribing certain money market accounts or savings accounts or whatever the case may be, can be kind of misleading. Here's the story that we're going to share with you on the program this morning to really help to kind of drive that point home. So this past week we had the pleasure of meeting with a 23-year-old trying to do the right thing, working hard. She's been working hard since she was 16 years of age and working for a very well-known and popular grocery store chain here in Florida, and you can probably figure out who that might be. And so the neat thing is that, yes, let me just confirm that she did meet directly with me. We still meet directly with beginning investors. Our view is always that they need help just as much as anybody else. Obviously, at Nelson Financial Planning, we have a team approach that allows us to still sit and talk with people of all ages and backgrounds, and ultimately we don't really have account minimums, never really had account minimums in the 40-year history of our firm. I guess our fundamental belief is that we actually believe in helping people with their finances without discriminating against people based on the size of their wallet. Unfortunately, many institutions do. We find that quite objectionable and really question the fiduciary nature of their business models if you're not willing to help people unless they have a certain amount of money. But anyway, that's my side rant. Let's get back to the story of the 23-year-old who had the pleasure of meeting with this past week. Worked hard since age 16, doing the right thing. She was contributing to her 401k. She was putting some money into her emergency savings. In fact, and this is where the story begins, she had actually saved over $50,000 just working hard, putting money away, doing the right thing, had paid off her student loans, and really had accumulated a good amount of money that was sitting in her bank. But here's where kind of her bank had really done her a grave misjustice or injustice, I guess would be the proper way to say that. Just as they are doing kind of unilaterally, and if you listen to the show on a regular basis, you know we've talked about this before. The banks have been very reluctant to change the rate that applies of interest, the rate of interest on savings accounts, checking accounts, and things like that, because they sort of control those rates. In contrast, when you think about like a mutual fund money market, those rates are going to float with whatever sort of the underlying Federal Reserve rate is. So what you've seen on the mutual fund money markets is those rates have all kind of trickled up, almost in lockstep with what the Federal Reserve is doing. Meanwhile, on the flip side, it really hasn't happened at banks. And this was the frustrating part. And here's the thing. They had led her to believe that she was going to get a better rate. They had set her up with, and I kid you not, this was the name of the account that she had. It was a premium money market, right? Sounds good, right? Premium, I must be getting something extra on that. And then they said the other requirement was that she had to keep at least $30,000 in this premium money market in order to qualify for said premium money market. And so she was doing that. She'd been doing that for a number of months. And she came to us and was kind of frustrated. She's like, I'm looking at this thing and there's just like pennies going into this every month. And so what we did was we helped her kind of figure it out. And ultimately, to figure out exactly what that rate was. And how we did that is by going to the source document. It's always important to kind of go to the source document. In this particular case, we were able to go directly to the year-end statement. And we've been talking a little bit about this, checking your year-end statements, particularly here in the first few weeks of 2024, because your year-end statement usually is a pretty good indicator of how the year went, right? And also has a lot of the disclosure stuff, expenses, how much you're paying for your advisory services, all of that usually shows on that year-end statement. So anyway, we went, helped her get online. She's got online on her phone, power of technology, right? And so we had gone through, clicked on it, pulled up the statement, and lo and behold, this premium money market that she had been pitched by her banking institution, the savings, the interest rate that it was paying was 0.01%. Yes, in fact, it was called a premium money market, but it was paying 0.01%. Folks, that's just terrible. And that is misleading to think that you have something. And here's this young girl who's trying to do the right thing. She's working hard, saving money, and assuming that her bank is doing the right thing because she has a premium money market. And that wasn't the case. Bottom line, and this is, folks, this is so important, so important. You have to always check things out. You can't just assume. You have to check things out. You have to take the time to double check what rate you are getting, what performance numbers you are getting, how much you're paying for all of that. Don't believe the label. Premium money market, it sure wasn't in this case. So we encourage you to really take the time, check out those statements, to really delve into the details of, okay, what exactly am I getting and what's the interest rate that I'm paying? Folks, unfortunately, we see this time and time again. The large financial institutions, the banks, the credit unions, they've got no incentive to raise those rates. They also know that those assets are what we refer to as sticky, unlikely to move or change banks, right? The average bank account in America is in existence for 17 years. The bank knows this, and so they know that there's just that inertia. So they haven't been rewarding their clients as much as they should be. So we really encourage you to take a much closer look at those rates. Look at those year-end statements. This is some important stuff on them. That's topic number one. Topic number two is this category of funds and ETFs that is getting increasingly pitched to the public, and that is this category known as alternative investments. And the pitch is sounds really exciting because the alternative investments are often described as hedge funds. Like you, regular Joe and Jill, can own a hedge fund just like and invest just like the super rich, like Jeff Bezos or Bill Gates or whatever the case may be. And so these are alternative because they're alternative to the not traditional side of things. And it's where the super rich play, and you can have like a hedge fund kind of thing inside your portfolio. Isn't that great? That's the pitch. The other part of the pitch is that, as the name suggests, well, it's an alternative, right? So alternatives, isn't that great to have alternatives? Because then it's an alternative to the regular portfolio, right? And so it's one that's going to provide greater return potential, and it works distinctly to kind of counterbalance what's going on in your overall stock portfolio and to help with market volatility. Sort of all of those things. So, this is going to zig when the market zags and everything's going to be fine. Well, we've never been particularly big fans of them if you're a regular listener to the program. And along comes a very interesting study out of George Mason University that really blows the lid off this whole sales pitch involving alternative funds. No less than 4 different conclusions from this study out of George Mason. Stay with us through the break, and we're going to share with you those conclusions coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We're sharing with you the results of this study out of George Mason University that really blows the lid off of this whole sales pitch involving alternative funds, alternative ETFs. Oh, average Joe investor, don't you want to invest like the mega rich and own hedge fund-like investments in the form of these alternative funds and ETFs? And oh my goodness, that you have to do this. These funds are going to zig when the market zags. You're going to make a bunch of money, et cetera, et cetera, et cetera. You know, if you're a regular listener to the program here on Dollars and Cents, that we've never been particularly big fans of these things because at the end of the day, there were some definite shortcomings. Along comes this study out of George Mason University that really sort of backs up some of the things that we've been saying on this program for many years as these alternative funds and ETFs have really become quite popular as sort of an alternative for more, I guess, selling the glitz, if you will, in terms of a particular investment strategy. So we wanted to share with you here on the program those 4 conclusions that the folks at George Mason University came to after analyzing the entire universe of alternative funds, ETFs, looking at data going back 15 years. So some interesting stuff indeed. Welcome on in, of course, to Dollars and Cents, where we help you make sense out of all life's decisions involving your dollars, including whether you should be owning alternative funds or ETFs in the first place. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great people who also are certified financial fiduciaries as well that stand ready this week to help you change your life with a successful and cost-effective financial plan. Give us a call at the office, 407-629-6477, or visit our website, Nelson Financial Planning, to request your absolutely free conversation with us this coming week. So here are the 4 conclusions out of that George Mason study about looking at alternative investments. Number 1, this category of investments doesn't actually provide much of an alternative behaving investment. After all, that's supposed to be its sole purpose. But as a whole, these types of investments, in terms of their risk-reward trade-off, looked an awful lot like a short or midterm bond fund. Nothing at all like a stock alternative in terms of their risk-return category based on, again, the extensive study looking at 15 years of data. So not really providing much additional balance to one's portfolio, if you will. Certainly not anywhere nearly serving the function that they are described to serve. If you're going to have a conservative part to your portfolio, it's called cash and bonds. It's not called alternative investments. Own bonds, own cash if you want to reduce down the underlying allocation or aggressiveness of your investment portfolio. Alternative investments don't actually provide what you're looking for when you're trying to do that. Number 2, as then you might suspect, the performance was quite a bit lacking relative to the markets. 15-year annualized return on this category of investments, basically around 3%. Same time period, the broad-based markets measured by the S&P 500 averaged over 12%. So got 12% versus 3%. To me, that's a problem. 4x difference over a 15-year period of time. That's pretty significant. Number 3, the third conclusion out of this George Mason University study involving alternative funds and ETFs is they actually don't provide any additional diversification. And this one sort of undermines the whole argument to have alternative investments. If you have alternative mutual funds to a stock portfolio, it won't actually diversify your exposure out of stocks to any significant degree. And after all, that's the sales pitch of why it's being promoted. So the thing that, large advisory firms sort of pitch on these things is, they're a counterweight to stocks, additional diversification, but doesn't actually hold any water based on the conclusions of this extensive study out of George Mason University. Number 4, we said there were 4 conclusions out on this study. Number 4, lastly, and this has always been probably our biggest beef about these particular investments, they're pretty expensive. The typical expense is 1.6% per year. That does not include any advisory fees that you would typically see laid on top of that. So with these types of investments, not uncommon to see them ranging from 2.5% to 3% all in terms of the expense. That's a pretty big drag in terms of your investment performance. Not only that, but most of these alternative funds have either an upfront cost or they have a redemption cost that is more than 1%. So here's the deal after those conclusions from that study. These alternative funds are certainly pitched extensively by large investment brokerages and advisory firms. They just don't work. They always have been. That's always been sort of our view, but now clearly fully confirmed by this study out of George Mason University. They're expensive. That's, being expensive is serves as a drag on your investment performance. They're sold to sound, I guess, sexy, for lack of a better word, right? Invest like the super wealthy, own the hedge fund strategy, all that kind of stuff. And that's really not a good reason to own an investment just because it sounds sexy. I mean, doesn't necessarily mean that there's performance behind it. So bottom line, folks, take a moment. And much like we said about checking your savings account or money market statements earlier in the program, really check out your investment statement. Again, those year-end statements are great sources of where to go for that. And ultimately, look at the pie chart. Most of those investment statements will have a pie chart, right? And they'll have a pie chart that breaks down your categories of investments. And so as you look at this statement, here's the question that I want you to ask. Do you see alternative listed as one of those asset categories? And if so, what percentage of your account is actually in that? Not uncommon for us to regularly see 5, 10, 15% of someone's portfolio in that particular area. And the problem is that if there's no performance and it doesn't serve a purpose or the purpose of which it's intended, and it's expensive, well, why have any part of your portfolio in it, right? So that part of your portfolio that was pitched to you with the concept that it was going to do something that it's not really doing, those are the kinds of things that you need to be aware of. That's why we offer free portfolio reviews at Nelson Financial Planning to help you uncover maybe those hidden risks to your investment performance, maybe those hidden risks in terms of the types of assets that you have. So check those statements. If you see the alternative category, we encourage you to call the office, because at the end of the day, you really need to understand what value or lack thereof is in those particular categories. So take a minute, review those statements. If you see alternative, I'd encourage you to call the office so we can kind of take a look at that and explain what exactly that is doing, particularly in light of the conclusions of this George Mason study. So certainly some things to think about. Bottom line, as is always the case, you just got to check that stuff out, right? Look at the information. Yes, I know some of these statements from some of these large financial institutions, they're 50, 60 pages. How are you going to ever find anything on there? We know how to find stuff on there. We've seen those statements time and time again as people have brought them into us over the years. So we encourage you to share that, and we'll be happy to take a look at that. Bottom line, look at the pie chart. If there's a portion that is in the alternative category, that might not be an alternative that you actually want. Anyway, we were 1.5 months gone into the year 2024. And last week on the program, we talked about some of the things that you need to focus on. I didn't quite get to the category because we spent some time talking about the Corporate Transparency Act. Again, encourage you to listen to last week's program if you missed it, particularly if you own a small business or you know somebody who does. It's new requirements that you've got to do with the U.S. Treasury in terms of disclosing beneficial ownership of that entity. But we're going to get to it in terms of these types of planning topics that you need to look at here in the new year. We'll do that after the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. What are those 5 planning topics that you need to be thinking about here in the new year? It's the start of the new year. The new year is already rolling by pretty quick. Here we are several weeks in. The good news is you got an extra day here in February. It's a leap year. So take that extra day to maybe spend some time on these financial planning topics that we're going to share with you in this segment of the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also happen to be a top 25 financial planning podcast. So make sure you check us out on your favorite podcast channel or go to our YouTube channel and you get to see the videos that we do as we do the program. Any trouble finding any of those channels, then you just go to our website, Nelson Financial Planning. While there, you could also set up a free conversation. Maybe have us take a look at your portfolio mix, particularly if you see the alternative category on there. It might be something worth digging into a little bit more to make sure that you've got a good allocation that doesn't have those types of categories of investments that just simply don't perform and are more expensive, as we were talking about in the last segment. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. Team of great folks there. I can't say enough about them. They also happen to be certified financial fiduciaries as well, and they stand ready to help you improve your life with a successful and cost-effective financial plan. So what are some of those things that you want to be thinking about as we think about your finances and the overall kind of planning picture for the year 2024? Anytime you have this conversation, it always starts with a portfolio review, right? That's what we were just talking about. Looking at your underlying allocation. What do you own? Not just stocks, bonds, and cash, but beyond that. What types of stocks, what types of bonds is your cash actually making more than 0 or 1% in today's world? Those are the kinds of things that you need to be reviewing. Also important because that underlying allocation, that mix, if you will, of stocks, bonds, and cash sort of determines where you are on the investment objective spectrum, right? So do you want to be conservative? Do you want to be growth? Do you want to be aggressive? Those types of things. All of these concepts, we certainly talk at length in our recently published book, Next Gen Dollars and Cents. If you have not had a chance to get yourself a copy of that book, we were giving it out for free for several months right after publication. It is now available on Amazon, so make sure you check it out on the Amazon platform if you want to order a copy of our book, Next Gen Dollars and Cents. By the way, if you come into the office for a face-to-face appointment, we usually will slide you a free copy. So if you want the free copy, then you can schedule an appointment. Anyway, the book talks a lot about the importance of that allocation, the importance of kind of understanding your goals, your objectives, things like that. So portfolio review, obviously, first and foremost, in terms of kind of a good financial planning topic in a new year. Second is funding retirement. When we talk about that, we talk about understanding that there are different income limits, there are different types of retirement accounts that you can use. The retirement contribution limits change every year. So those are the things that you need to be aware of, particularly as it relates to what bracket you are in. We often hear the debate between the traditional IRA versus the Roth. Traditional IRA, you get the tax savings now, but it's taxable later. The Roth, you don't get the tax savings now, but it is tax-free later. A lot of that analysis depends on which tax bracket you're falling in. So it's important to understand retirement contributions, particularly relative to which tax bracket you are in. If you're putting money in on a regular basis into a retirement account, know that the limits have changed. They change every year. A couple of weeks ago, Kristen, a fellow certified financial fiduciary, CPA at Nelson Financial Planning, shared with us kind of those increase in limits. Those numbers go up every year. This year, obviously, based on inflation, they've increased. So if you're putting money in on a regular basis, then you need to kind of adjust how much you're putting in to make sure that you're hitting the full maximum for this year. The third topic would be setting goals, right? Important to really kind of set those goals. The best way, once you set those goals, to achieve those goals, is not enough to just set them, right? You got to figure out a strategy to achieve them, is this notion of using a budget. Great radio show that Christina and Rob did last summer talking about budgets and really converting that budget word into an acronym to kind of really hit the highlights of what you need to do when you establish a budget, because it's with a budget then that you can actually achieve your goals. Our book, Next Gen Dollars and Cents, actually has some QR codes in it that link to a budget. It's pretty robust. It's sort of an Excel spreadsheet thing that we did internally in the office. And you can download that and work with that, change it, make it your own. So we encourage you to really think about that. Another thing that we're seeing a little bit more of, and this is kind of an interesting trend, I guess, or burgeoning trend, is more people are having conversations about trying to help out their next generation, their kids, their grandkids, now while they are still living, rather than have money flow after they're gone. We think that's a very valuable conversation, and part of this notion of setting goals, particularly here in the new year. Number 4, you can't forget an emergency savings fund, right? Got to have that. That is almost fundamental 101, the first step in terms of financial planning in order to get your finances in the best possible shape. So crucial to have that. Unfortunately, when you look at the surveys and the stats, many Americans don't have that. We encourage folks to start there if they're just starting out. Make sure they've got a chunk of money in that emergency savings account. And then lastly, taxes, right? Can't get out of anything without having an understanding of your taxes. Certainly that time of year, start reviewing tax returns internally at the office. At Nelson Financial Planning, we actually do prepare tax returns for clients, and so that means that we're in the process of putting that data in the software and generating out returns, and then we're taking a look at those final returns to make sure that they are what they need to be, and then ultimately using them as a planning tool for the year ahead. And we've talked about this before on the program. Far too often people take their tax return and just put it in the file cabinet, right? Or in this case, I guess it's all electronic, right? So you take it and you put it in the cloud somewhere and you don't actually look at it. So it's important to really take a look at it and use that as a part of a document for sort of planning out the year ahead, because at the end of the day, that's going to give you a pretty good idea of your income. Also, would show some of the deductions and some of the other expenses that you would have as well. And then, of course, on your tax return, trying to maximize out the deductions. That doesn't really happen as much anymore with the new higher standard deduction and some of the limitations, including the $10,000 limitation on state and local and real estate taxes. But certainly good to always look at that, particularly in a year where you may have a much higher amount of medical expenses. And then there's a ton of tax credits out there. This year, a number of educational ones. There's always been a number of educational ones. I think there's like 4 different variations of an educational tax credit depending upon what you're doing, what year you are in school. So make sure you have an understanding of that. Ton of energy credits. Kristen Cayley was on the program 3 weeks ago, talked a little bit about these energy credits, whether it be for cars or windows and doors. And then child related, whether that's dependent care or child tax, a bunch of tax credits that are floating around out there. So bottom line, those are kind of some of the categories that you need to be thinking about in the new year to get your finances on the best possible course of action. If you want to sit and talk with somebody, that's what we're here for at Nelson Financial Planning. So reach out to us. All of our conversations are absolutely free of charge. Go to our website, Nelson Financial Planning, or you can just give us a call, 407-629-6477. And yes, indeed, there'll be a live person that answers the phone, as there always has been for the past 40 years at our company. Well, we wish you well. Thanks for listening on into the program. Happy Super Bowl Sunday, and we wish you a very good day indeed here at Dollars and Cents.